In today's video, we're going to take a look at the four major index markets and see what kind of volatility the day presented us with. Now, for all Volatility Box members, I've also updated the Cumulative Tick Pro indicator with new data over the weekend. I sent out a note in the weekly email. Be sure to download this latest update. I've noticed there's actually a little bit of a difference here, about a 20% delta in the levels the cumulative ticks typically tend to reach across the board. The different ticks that we look at, the NYSE, the Dow, the Nasdaq, and the Russell ticks. And I've included all of the latest data here so you have it for the pro version of the cumulative tick indicator. Now, in today's video, I have the free version loaded on so everyone can follow along. And I've also loaded in our aggressive volatility box models. The aggressive models were what the four major index markets were on, and we saw a lot of breaches today across the board. So let's start with the S&P first. Now, before we dive into the charts, first take a look at the cumulative ticks. You would think with the steady decline, the cumulative ticks should have resulted in price action seeing substantive selling pressure here. Instead, we saw a whole lot of chopping price action here while the ticks continued to decrease. That, if we switch to a 5-minute chart, becomes even clearer. You can see just how many gray dots across the board here telling you that every single time the ticks just kept decreasing in that total cumulative count compared to the previous bar, with small pockets of bullish activity baked inside of the day. But across the board here, the ticks would have suggested bearish pressure. However, price actually resulted in choppiness. Now, with that choppiness, we had a lot of breaches with our volatility box models. The first breach happened towards that 7 a.m. mark. This is right at the cusp of when we're determining which volatility box model to use, and that's when we had price action breach our long side zones. For those of you that are a bit more aggressive and use that opening range breakout setup, this was that V-shaped reversal setup that we talked about in that exact video, triggering one more time here. Now, this long side setup took us all the way to the other side's volatility box models. However, we missed that breach by right around 20 minutes for where this price chopped. So 20 minutes earlier, and that would have been a really nice short setup, and that was a bummer given how quickly we saw price fall. Now, when price fell, it fell straight inside of our long side volatility box models, fell inside of the models, we saw that first leg bounce, we then saw the edge signal confirmation here. The edge signal is our overbought, oversold confirmation. Again, for all Volatility Box members, this is included with your membership. And after we saw the edge signal, you can see what that bounce looked like to the other side. Now here, we never got the retest back to the cyan line. You had to use something more like those 0 days to expiration option strategies that we've discussed in the past, where you use this area right here as your zone for your entry, trying to go for something like a risk 1 to make at least 1, if not 2, which in this case, we had about a 14-point risk inside of the S&P here, and you went for about a 28-point reward with the move straight inside of our target line. So this was that particular setup right before the lunchtime hour, the 8 to 9 a.m. Pacific breach. Now after that, we had the lunchtime hour where price just chopped around. After the lunchtime hour, price started to pick volatility back up, but we didn't quite breach the long side zones for the rest of the day here. We came close here, only triggered that zone, but we bounced away before we hit the cyan line, which is where I would start to be looking at for a long side entry. So that was the S&P 500 here. Now let's move on next to the Nasdaq futures. So I'll load in NQ. Same thing, NQ very quickly caught up to the rest of the index markets. It was the first market on the scalper models. But with this breach here, we went outside of our zones, and this is where we switched over to the aggressive models. However, for that morning opening range setup, we had the same thing just like the S&P 500 breaching the scalper models. Here, even getting that retest of the cyan entry line right below that previous wick before we saw that massive move up. Again, this is that opening range breakout setup. I'll leave a link to it in the description box below if you haven't seen it before. Now, once price broke outside of our volatility box models, that was our sign that, hey, you can no longer scalp inside of the Nasdaq. We need to switch over to the aggressive volatility box models. No breach in the 7 to 8 a.m. Pacific hour, but in the 8 to 9 a.m. Pacific hour, just like the S&P, we tagged the cyan entry line in this puke down lower. Once we tagged the entry line, we had the 2 edge signal confirmations, but only a small retest back to the zone. So I would say the Nasdaq did not really give you the same type of an entry that the S&P did with this zone here. You had to be very aggressive, and I'm not sure that it was worth the additional risk outside of the zone. The Nasdaq, for the rest of the day, no other breaches. Next up, we move on to the Dow futures. The Dow in the morning had, I think, the best opening range breakout setup. We had so many of these Keltner channel wedges plotting, falling straight inside of our volatility box models, and this was about as perfect of that V that you can get with that V-shaped reversal. Now, just like the other index markets, we had the breach in the 8 to 9 a.m. Pacific hour. We had the edge signal confirmation. We had price chop right around here, but it's still above that zone that we're looking at for an entry before we saw that rally. Now, what's interesting in the Dow is in this sell-off that we continue to see, we missed the breach here by 1 minute. We saw that breach into that next hour at the end of the lunchtime hour, what would have otherwise triggered a long side setup here inside of the Dow. Finally, we move on to the Russell futures, and inside of the Russell, nothing too exciting. We broke outside of the scalper early in the morning. That was our sign that, hey, you can't really be looking at scalps for the rest of the day inside of the Russell. And off of the aggressive models, no real breaches. So the S&P here for both SPX traders along with ES traders and SPY options traders, of course, was, I think, the market to look at for the day. It gave you some of the cleanest setups, and if you layer on the cumulative ticks along with some of the strategies that we'll discuss, I think you can find some really nice patterns and some ways to overlap market internals and identify moments like this where the internals are telling you one thing, but price action is doing another, and you have a specific bias that you can use. I hope you found this video useful for all futures Volatility Box members. I'll add one last note before I head out. If you do have access to the TradingView platform for all futures Volatility Box members, I'd highly recommend configuring alerts there. I found that platform is really good at notifying you when price does cross these VB models, and it can send you an alert directly to your phone, and that's the closest thing to real-time text alerts for futures that we can get to really work around the TOS latency that you'll see with alerts when it comes to futures markets. Take care, everyone, and I'll see you in our next update.